Hello, thank you for joining us for a presentation on accounting changes and error corrections. I'm Austin Roberts, and joining me will be Peter, Laura, and Elisa. Utilizing the proper GAAP treatment for accounting errors and changes is vital to the integrity of financial reporting. Properly reporting errors and changes allows for the greatest utility of financial statements by ensuring comparability and consistency. This presentation particularly focuses on the treatment of changes in accounting principles, estimates, and reporting entity. So, the background on the GAAP process: the FASB establishes rules and guidance regarding the reporting of financial statements by issuing Statements of Financial Accounting Standards, or SFAS. Before something can become GAAP, there are several steps that must occur beforehand. The first thing that must happen is the FASB must identify a reporting issue. Once an issue is identified, the FASB then reaches out to the public for concerns and opinions regarding the issue at hand. After receiving feedback, the FASB creates a draft of a proposed solution and releases it to the public for further critique. Lastly, the FASB issues the SFAS and adds it to the GAAP codification. The SFAS that addresses the topic of this presentation, accounting changes and error corrections, is SFAS 154. 154 came into effect at the beginning of 2016, which was after the IASB released changes to their IAS, with International Accounting Standards number 8 becoming effective in 2015. So FASB's changes came as a result of working with the IASB in efforts to improve the comparison of financial statements between organizations reporting under GAAP and those reporting under IFRS. Prior to 154, voluntary changes in accounting principle were to be recognized by increasing or decreasing net income to the amount of the effect of the change in the period the change was made. 154 now makes it required to use the retrospective approach to all financials of prior periods, which Elisa will now cover in more detail.
Changes in accounting principle are either voluntary or required due to a codification update. Voluntary changes have to be justified on why a different principle is preferable, while required changes need no justification. Once an accounting principle is adopted, it is expected to not be changed for any similar event or transactions. The initial adoption or modification of a principle for an event or transaction that is clearly different in substance is not considered a change in principle. The retrospective application of an accounting principle requires that the cumulative effect be reflected in the carrying amounts of assets and liabilities in the beginning of the first period presented. An offsetting adjustment is made to retain earnings if needed for the period. The financial statements are adjusted in applying the new principle to each prior period presented. The impracticability exception to retrospective application can result in limited or sometimes no application to prior periods. There are two scenarios where this exception can be used. The first is when the cumulative effect can be determined but is impractical to determine the period-specific effects for all prior periods. The second is when it is impractical to even determine the cumulative effect. In order to limit the exception, companies must take every reasonable effort to apply the requirement. Companies can use the exception if an assumption of management's intent cannot be independently substantiated or it is impossible to objectively distinguish information about estimates. For an example of change in principle, Starbucks in their 2006 10K had changes to their asset retirement obligations. In the beginning of their fiscal year, Starbucks adopted FASB Interpretation Number 47, also known as FIN 47, of FASB Statement Number 143. This requires the recognition of a liability at its fair value when the ARO is incurred. The AROs the company had were primarily related to the disposal of leasehold improvements, returning leased properties to an agreed-upon condition. The impact of the adoption of FIN 47 was a net expense of $17.2 million, or 2 cents per diluted share. The net amount was recorded as a cumulative effect of a change in accounting principle on the consolidated statement of earnings. FIN 47 requires that the cumulative approach to adoption be used rather than retrospectively revising prior period financial statements.
Moving on from changes in accounting principles, we have changes in accounting estimates. Accounting estimates can be used to anticipate the possible accounting events in the future under the accrual method. Accounting estimates can be used to determine uncollectible accounts, pension benefits, and depreciation. The depreciation method seems like it would be an accounting principle, but is considered an accounting estimate resulting from a change in the accounting principle. Depreciation methods are used to predict the future benefits and costs of long-lived assets, thus making it fall under accounting estimates. Companies change estimates in response to new information and forecasts that could better predict what the actual result might be. When faced with a change in accounting estimate, FASB requires companies to use the prospective method instead of the retrospective method. The prospective method is applied by implementing the change in estimate in the current or future periods. Since a change in accounting estimate is meant to reflect the future benefit or sacrifice, the retrospective method would not be a proper treatment because the estimate doesn't reflect sacrifices or benefits in the past. The company then must leave a disclosure note if the change in estimate has any material impact on the balance sheet or the income statement. As spoken before, the retrospective method can be inadequate for changes in accounting principles. When companies lack the information to apply a new accounting principle on previous reports or show the cumulative effect on retained earnings, the prospective method is the appropriate treatment. To use a retrospective method, a company must have proper tracking to use accurate values for previous years under the new principles. Even if a company has some but not all information needed, the method is then impractical. A company then can only be able to reflect the change in current or future periods by using the prospective method. An example of the impracticality of the retrospective method is switching from FIFO to LIFO. Since LIFO has layers when it comes to the cost of goods sold, it can be difficult for a company to calculate the cumulative effect, especially when the company didn't track their cost. They would then have to use a prospective method for the current period and leave a disclosure note on why the retrospective method was impractical. Another use for a prospective method is when it's required by accounting authorities. Some voluntary changes in principle are required to use a prospective method and not the retrospective method. An example of this is a company elects to switch from the equity method to a different method for the long-term investments. Here is an example of the prospective method. In year 1, ABC Company purchased machinery for $10,000 for a useful life of 5 years. ABC Company decided to use a straight line method to depreciate machinery. At the end of year 1, ABC made an adjusting entry for depreciation of $2,000. At year 2, ABC decided that their machinery will last an additional 2 more years than what they previously estimated. For the adjusting entry, ABC recorded depreciation of $1,333, which is the current book value of $8,000 divided by the new useful life of 6 years at year 2. This change in depreciation will increase retained earnings by the difference of the expenses in the 2 years by $667.
Accounting changes and error corrections also include accounting for a change in reporting entity. Unlike accounting for estimates that typically require a prospective approach, as Peter just discussed, a change in reporting entity requires a retrospective application. So I'm going to start with the basics. First off, a reporting entity is a company or group of companies that is reporting its financial statements for various uses. A change in reporting entity is any change that results in financial statements that are those of a different reporting entity. So there are 3 primary changes a company or group of companies can undergo that would result in a change in reporting entity. The first reason is that the company chooses to present consolidated financial statements in the place of individual financial statements of each company. So if a group of companies originally produce individual financial statements, if this year they decided to present consolidated financial statements, they would be undergoing a change in reporting entity. The second reason is a change in the specific subsidiaries that make up a group of entities that present consolidated financial statements. For example, if a parent company adds or removes one of its subsidiaries, this may result in a change in reporting entity. Finally, any change in entities included in the financial statements results in a change in reporting entity. So for further reference and understanding, I've included a chart that further details what a subsidiary is, as well as a picture of some of Amazon's subsidiaries. So the most common cause for a change in reporting entity is one company or a group of companies acquiring another company. However, it is very important to note that a change in reporting entity may not result from this. Companies can choose to not include a new company in their consolidated financial statements. This is called an unconsolidated subsidiary. This scenario would not result in a change in reporting entity. To dig a bit deeper, there is very specific GAAP treatment for accounting for a change in reporting entity. First, GAAP requires the company or group of companies retrospectively applies this change. We have briefly discussed the retrospective application previously in this presentation. Ultimately, this means that the company must restate the financials of all previous periods as if the new reporting entity had already been in use. Further, GAAP treatment requires the inclusion of a disclosure note in the period of the change. The FASB codification standards requires that this disclosure note details the nature of the change as well as the reason for it. Additionally, the company must present the effects on net income, income from continuing operations, and any related per share amounts for all periods presented. An example of a change in reporting entity is Hartford Life Insurance Company. The reason for the change was Hartford was changing the subsidiaries that made up its consolidated financial statements. This is an example of reason number 2 of the reasons I previously listed. Ultimately, Hartford Life reorganized their business. As a result, they decided to include additional subsidiaries that they already owned into their consolidated financial statements. Following GAAP treatment, Hartford Life retrospectively applied the change to their financial statements. They included a disclosure note in the period of the change that detailed the reason and the nature. The reason given by Hartford was to more efficiently distribute capital across the company. They also reported a $1.3 billion increase in shareholders' equity as a result of the change. So to conclude and summarize, we've discussed Chapter 20, Accounting for Changes and Error Corrections. We have particularly focused this presentation on changes in accounting principles, estimates, and reporting entities. Thank you so much for your time.